please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, after months of uncertainty and speculation, the Fortis Health Care Board finally approved a binding proposal from Malaysia-based IHH Healthcare, which will invest around 4,000 crore rupees via preferential shares, and this will be followed by an open offer for all the minority shareholders. Now, the Malaysian hospital giant, in an exclusive interview to CNBC TV18, says they're bullish on the India's health sector, and the group believes its open offer price is fair and that it will pump in an additional 2,000 crores in Fortis post the acquisition, maybe via a rights issue. Let's listen in to that excerpt.
Given the headwinds that's coming, we believe that this is actually quite a fair price. I think that given the fact that whatever we put up on the table itself is a premium to what the market price is being traded as today. I mean, for those who want to exit, we have the opportunity. We have given them the opportunity in an all-cash deal. And for those who believe in our story and who want to ride the upside with us, we would certainly welcome them to support us.
Are you going to put in more money once the deal is consummated? How much are you looking at for the ship to really stabilize quickly? So
our estimate is that the company needs probably something closer to 5,800 to 6,000 crores. Yeah. All right. Now, like I've said earlier on, we have also taken into consideration, because in the run-up to the offer, we have also taken into consideration the wishes and also the aspirations of many minority shareholders who said that they don't want to be diluted excessively at whatever offer price we put up, because they want and they believe that with us coming in, the price would be able to stabilize quite quickly. The other 1,800 crores, we believe that after the moment that we remove the effect of the leakage in terms of the rental paid to the RHT, the company's EBITDA will go back up, I think, in a steady state, probably some 500 crores a year. So that, and in terms of the restructuring of some of the deadlines, we would then be in a better position to leverage, up another 1,000 to 1,500 crores. And in the event that we can't do that, we always have the option to issue a rights issue.
Is there any condition that you have that if you don't like what you see, you can walk away?
No, we are committed to the deal. I think, of course, at this particular point in time, we are still subject to, our process is still subject to us going to the shareholders for their approval. And of course, the CCI, the Competition Commission of India, would also have to clear that. So these are the two main hurdles that is left.
Well, on to some earnings now. FMCG giant Hindustan Unilever met expectations on most count. Manglam joins us to run us through his analysis of those numbers. Hey, Manglam, morning.
Morning, Nigel. So no complaints as far as just the numbers for HUL in the first quarter are concerned. If you take a look at the revenue, closer to that 9,500 crore mark. The street was working with 9,650 to 9,700 crores out there. 100 crores, smidge lower, but I mean, at that base, no real complaints. If you take a look at the volume growth, that came in at 12%. The street was working with a range of 11 to 12%. No complaints there as well. EBITDA, the company made up for the loss in revenue by improving their EBITDA. So the EBITDA came in at 2,251 crores. This compares with a poll of 2,200 crores. And the net profit, that came in absolutely in line with the expectations. Now the good things about the result. So the gross margins, they expanded by about 200 basis points. This is a trend we'll have to watch out for going forward, given input costs have increased. The company did not penny pinch on advertisements. In fact, ad spends have increased about 27% year on year. Despite that, we've seen some improvement come by on the EBITDA margins. And the net profit, while it is in line with expectations, contains a bit of an exceptional. So if you take a look at the net profit adjusted for exceptionals, it is a little higher than what we were working with, 1,570 crores thereabouts. So this marks the 3 quarters in a row where Hindustan Unilever has reported double-digit volume growth. So we'll have to watch out for what happens going forward, given the advantage of a favorable base will now slowly wane off. The management saw a gradual improvement in demand. Their key worry, of course, is the depreciation that we're seeing in currency and the volatility that we're seeing in crude, as well as competitive intensity. That is something they expect to move up. So what does one do with the stock? Well, the stock is up more than 50% over the last 12 months, more than doubled in the last 2 years. So keep an eye on the fact that valuations are pretty high, close to around 52 times FY20 earnings. So that is something that the brokerages are not very comfortable with, because when you're trading upwards of 50 times, perhaps the brokerages believe that inline is just not enough. So we've seen a smidge of a downgrade come by from Jefferies, PL, Axis Cap, as well as Kotak. Kotak is the only one who's maintained their reduced rating, but most of them, while they've upped or kept their target prices unchanged, they've downgraded a smidge only because of valuations.
On to the latest in the LIC IDBI Bank stake sale. The LIC board has approved acquiring majority stake in IDBI Bank, and today the IDBI Bank board will meet to approve the 51% acquisition by LIC. Ritu Singh is here with all of the details on what's lined up on the agenda.
The board of IDBI Bank will be meeting at 3 p.m. today to approve the acquisition of 51% stake in the bank by Life Insurance Corporation. Remember, LIC is already a shareholder of the bank and owns about 7.98% stake, and it will acquire an additional 43% to take its shareholding to close to 51% stake in the bank, becoming the majority shareholder. Government's shareholding, which is currently at about 85%, will come down to below 50% post the closure of this deal. So also on the agenda is the approval of nominee directors. Remember, the DEA secretary yesterday said that about 4 nominee directors from LIC will be appointed to the IDBI Bank board. That is also something that should be finalized in today's meeting. The other thing would be the turnaround plan itself for IDBI Bank, which has a gross bad loan of almost 30%, one of the highest NPAs in the industry. So all of these will be on the agenda. It is important to get the bank board's nod, but even after that, there will be regulatory approvals required from both SEBI and RBI that will be pending to close, what is one of the largest banking deals in recent times.
Okay, all right, Ritu. Thanks so much for that. Well, let's go on to some earnings that are expected today. Auto major Ashok Leyland will be in focus ahead of its Q1 numbers. Sonia's with us to run us through those expectations. Hey Sonia, good morning.
Hi Nigel, good morning. Thanks for that. I think the market will focus more on the notifications that come out from the new axle load carrying capabilities. And, since there's a lot of, there's lack of clarity on that currently, the stock perhaps could be under pressure. But for the numbers itself, the base effect will kick in this time around, on account of which the growth will look very good for Ashok Leyland. Remember, same time last year, the company was hit both by demonetization as well as by the BS4 transition. And on account of that, the numbers same time last year were very weak. This time around, we're expecting a 50% growth in the revenues, the EBITDA to double, the profit to triple. But if you look at it quarter on quarter, there are pressures definitely that will, bring down the margins quarter on quarter. Now, this time we're expecting margins of 9.6%. This compares to an 11% margin that they clocked in Q4 and in Q3. Raw material costs have gone up. That will put pressure on margins. Not just that, discounting levels have also gone up for the industry, and that will also put pressure on their margins on a quarter-on-quarter basis. But year-on-year, things look fine. If you look at the volume growth as well, it's been a 42% volume growth that the company has clocked in this time around. This compares to 23% volume growth in Q4 and 42% in Q3. So it's done much better than the last 2 quarters, of course, because of the base effect. The medium and heavy commercial vehicle segment has grown substantially. That's because, of the shift to higher tonnage trucks that we've seen over the last 6 months or so. That has helped with margins as well. However, as I said, today the focus will really be on the new load carrying capabilities and the norms. There is a lot of uncertainty with respect to that. So perhaps you could see some more pressure on the stock.
Okay, all right, Sonia, thanks very much for that. So yes, a lot of news to reckon with for Ashok Leyland besides numbers, but Zee Entertainment will also be coming out with its Q1 numbers. Sonal is here to tell us what we can expect from the entertainment major this time. Sonal.
Good morning, Ekta. Well, we are expecting good set of numbers from Zee Entertainment this time around. Though the stock has been an underperformer, but in terms of revenues, we are expecting a growth of around 15% at 1,800 crore rupees. EBITDA is expected to grow at around 30%, and margins, they are expected to be that 30% plus mark at 31.5%. An expansion of 350 basis points on a YOY basis is what we are expecting. All this leading to a profit increase of around 40-odd%. But if we split the revenues into two, the ad revenue growth, that is expected to be robust this time around. That is because the company has been able to gain a lot of market share in the quarter gone by. So we're expecting an ad revenue growth of around 19 to 20%, and that will be driven by international ad revenue growth of around 14 to 15%. In terms of subscription revenue growth, that will also be good at around 11 to 12% on a YOY basis. That will be driven by a domestic subscription revenue growth of around 13 to 15%. However, some pressure will be seen on the international subscription that is expected to decline by 2 to 3%, because the management had told us earlier also that they are seeing some sort of pressure in some of the Gulf countries. In terms of margins, again, content costs, they are expected to go higher because they had launched their OTT app called Z5. So we look out what the impact of those higher content costs will be on the margins. However, we are still expecting an expansion. Management commentary post Q4 of FY18 said that they are expecting margins to remain in that 30% plus range. Also, they are expecting ad revenue growth to be in double digits in FY19. So today as well, after the results, management commentary is something that we'll be watching out for. Back to you.
Hopefully going to have a bearing on today's markets as Brent crude prices cooling down to around $72 on a per barrel basis. Manisha Gupta joins us with details on that. Hey, Manisha.
Hey, morning, and thank you for that. Well, yes, we did see 4.5% of cut come in for the Brent prices, 4.2% for the U.S. crude oil as well. The Asian markets, of course, have gone in for some bargain buying, so some green on your screens for that. But yes, we are trading at around 3-month lows for crude, and various reasons for that. The major, of course, being that the U.S. is now looking to exempt some countries, and there are reports on how some U.S. officials are going to be in Delhi this week to discuss with India on how long and how much can they cut on Iran oil and what kind of exemptions can they look at. So similarly, there would be other countries who would be looking at exemptions. So U.S.'s softening stance on Iran sanctions, of course, has led to the prices going down. Apart from that, it has been the IMF report, which has indicated a slowing growth, economic growth, especially in countries like European Union, UK, Japan, etc. And all of these countries are big consumers of crude oil. So slowing economic growth perhaps would mean slowing demand, and that's yet another reason that you have seen the crude oil prices decline. Also, the kind of supply concerns we were dealing with seems to be easing away. There are potential supply increases that we are seeing in the global markets, and that is the reason you have seen crude under pressure. We have broken below important support levels, and some more pressure is something that the markets will be looking at. So further lower lows on crude oil price is not ruled out in the days to come.
Okay, all right, Manisha. Thanks very much for that. Well, let's go across to Mangalam now, who joins in with all the cues from the F&O space. Mangalam?
Well, Ekta, the cues from the F&O space, I would see it more with silver lining than anything else, especially given the sort of moves that we saw yesterday in our markets and the decline in the crude prices. So the FIs, they ended up buying 600 crores in index futures at lower levels. A lot of shorts were unwound. So if you take a look at the internals out there, the FIs actually unwound close to 6,500 shorts in a market that was falling yesterday. Not just that, there was purchase of close to 1,700 crores in index options as well. There was protection on the downside, sought close to around 11,800 puts added, but at the same time, the FIs kept the window for an upside higher or open with purchase of close to 11,800 calls as well. The put call ratio, which was heady closer to that 1.79 mark, has become less heady at 1.62 as well. So with these things, I will keep an eye out on the 11,000 mark. The battle is between the bulls and the bears out there. The 11,000 call saw some writing yesterday, while the 11,000 put saw some shedding. Let's see where that pans out. There was some short covering on Indraprasth Gas in terms of individual stocks, fresh shorts on PC Jeweler that fell about 26% yesterday, and some longs were unwound on the underperformers DCB Bank as well as Dr. Reddy's.
Okay.